Right, good morning to our audience, and thank you very much for joining this session today on the South African fixed income environment. I'm Eugene Brock from Boutique Investment Partners. We're one of the largest independent asset consulting firms that provide asset allocation and fund manager research to intermediaries, or rather put financial planners. And if you are attending the session, you would have received an invitation or the recording from your financial planner. Your financial planner has a range of actively managed solutions, ranging anything from interest-bearing or income-type portfolios to things like local and global equity. You may very well be invested in one or more of these solutions, depending on your very specific financial plan or financial needs that you discuss with your financial planner. Today, we will specifically focus on South African fixed income environment, or rather put income portfolios or income funds. Joining me today is one of the top fixed income managers in South Africa, Arno Lorenz, who's also the Chief Investment Officer at Sasfin Wealth. Good morning, Arno, and thank you so much for your time this morning. We really appreciate it. Arno, maybe just from my side, given the very high interest rate environment that we are in at the moment, fixed income instruments that ranges anything from bank deposits or money market or bonds offer investors some very, very attractive rates. This is maybe not so great for people that has debt or owing money to the bank, because I'm paying a lot more interest, but it's most certainly exciting times for investors investing in income type funds. And just from my understanding and that of the audience, simply put, you and your team look at all these different instruments that can range anything from cash to bonds to corporate bonds, to try and find the best possible interest rates or yields, differently put, for clients, while keeping an eye on risks, because we know there's no such thing as a free lunch. We're very keen to better understand how you do this, how you look at the world, and what investors can expect.
Great, thank you, Eugene. I'm going to keep it short today, so I'm going to skip out a lot of the technical detail, the nuts and bolts of what we do in terms of putting funds together and so forth. But I hope what I do cover today at least gives you a sense of, number one, the opportunities that income investors have in South Africa, and then number two, what we're doing within our funds in order to generate a return which is commensurate with what people expect, and also making sure that it measures up to, in particular, a risk management framework, so that people don't have to worry about things and can sleep easy at night. So I think that's really what I'm going to cover, basically. So hopefully that hits the spot. Okay, so I'm going to jump straight in, and of course, every asset manager, I suppose, always got to start with a brag sheet, I suppose, but I don't call it a brag sheet. It's really just to highlight the fact that, through the years, we've actually won a number of awards. This year so far, the Raging Bull Award for the High Yield Fund. Next week is the Morningstar Awards, and our Stable Fund is up for an award as well. And I think the message here really is one thing, and not that we win awards or whatever the case is. I think what it speaks to is the fact that what we're actually doing as fund managers ends up winning awards, not because we're trying to win the awards, but because we're doing the right things at the right time. And I think that's really speaks to our team, and it speaks to our process that we follow in terms of making investment decisions. Okay, so let's move on. Where do we start? So one can always start with a big picture. And if you look at where we have big picture of the world, what you can see there is Africa. And I think you could take two things from this picture. Number one is that if you look at South Africa, there on the southern tip of Africa, we're far away from everything. That can be a bad thing, but it can also be a good thing, especially if you think about what's going on in Ukraine and Europe and many other places around the world with natural disasters and so forth. We're actually, from that perspective, fairly stable. So yes, we have our own idiosyncrasies, and we can cover those. But I think that's number one, is we're quite isolated as a country geographically. I think that's the first thing. But then there's a little giveaway here as well, which is that then look beyond this and look at the clouds. And you can see that there are systems there And essentially these systems, and they are climate systems, impact us equivalently to everywhere around the world. So yes, we are connected. And in the same way is we are also connected in the financial system. So even though geographically we are quite isolated, we are connected, and we can't ignore the fact that what happens in the rest of the world is actually going to impact what happens here, and in particular in investment markets. So I think that's the important part to start with, and then to actually realize that these global forces are something that we need to be cognizant of. Okay, so now let's go from the macro to the micro. So if we then start looking at, what are these macro risks? If you go on the World Economic Forum, you can see in their report, they highlight what the risks are in the world, and you can see all these lines between them. And the size of these little bubbles are the size of the risks that they've estimated, in a sense. Interestingly enough, of course, is that given what's going on at the moment around SVB, the Silicon Valley Bank, and Credit Suisse and so forth, you can see that one that I've highlighted there, debt crisis, as one of the issues that, or one of the risks that is apparently now starting to be out there. And these risks are things that I suppose in a way we should be fearing. But they also present opportunities. And, so when we start looking at these risks and how interconnected the risks are, then it becomes an extremely complex picture. So that's my job, ultimately, to make sense of this. And the way that I do this is quite easy. My to-do list. This is the micro, by the way. So you'll sort of have a look at this, and yes, I'm a human being. I have on my to-do list that the trees need to be pruned, et cetera, the garbage needs to be taken out, etc. So the balance between the two is from macro to micro. What we want to be able to do is, and what I want to be able to do as a fund manager, is sleep easy at night, so that my investors, i.e. the clients, can sleep easy at night. So I'll park that. Hopefully you delete this, my to-do list there, Eugene. There's no report back to BCR on the to-do list as at the moment. But anyway, okay, 2022 was the year of crisis. If we look back, we know that there were, multiple crises in a sense, and I can go through this quickly here. We understand this. There was the COVID supply chain crisis. There was the cost of living or inflation crisis. Central banks were very slow to respond. There was a issue around their credibility. Then there was the energy crisis in Europe. There was rising political crises, for example, in the UK in particular. And then if you put all of this together and you ask, where does all of this end? And I must admit, I was quite surprised, because right at the bottom there on the right, you can see crumbling credibility, stubborn inflation, the pace of interest rate hikes, highly leveraged market conditions. They created all these ingredients that you threw together. And this was the recipe. And the one thing that I was surprised about was how long it took before something fell over. And so now we're starting to see, the Silicon Valley Bank falling over. There was another bank there in the US, and then Credit Suisse, there are issues there as well. So I was surprised by that. But, when you threw all these ingredients together, there was this thing of like, it doesn't just go away. You can't hike rates as quickly as what happened in 2022 and think, it's all going to be hunky-dory, soft landing, no problems. And we're starting to see some of these things start to play out. Having said that, I do see 2023 as a year of opportunity. And the reason why this year is different to last year is because a lot of those issues and crises we know about now, and we know where the risks lie, to the extent that we know what needs to be priced into asset markets, both on the equity space and on the bond space. So, where we stand at the moment is that, yields have been elevated. We understand where inflation is. We know the trajectory. We know where the risks are. And so we can start positioning ourselves now for what comes afterwards. So I think that's really the key. Well, there's two key things I suppose you can take from this. The one is, because we understand this, we know where we can take opportunities. And the other one is the old Warren Buffett saying, where he used to say that it's only when the tide goes out that you see who is swimming without shorts. And what that is about risk management. So this is about when things start falling over and when the dominoes start falling, you start to see who was taking inappropriate risks. So I think that's the key message here, is that what we're trying to do is take the opportunities, i.e. the return opportunities, but at the same time ensuring that the risks we're taking are appropriate to where we are today. I think that's really the message that we want to portray very, very strongly here. So I won't go into detail really about why this is the year of opportunity, but if I summarize what's going on in the world at the moment, ultimately what we sort of really are I suppose speaking about is that your elevated interest rates create opportunities for income investors. as you rightfully said, Eugene, is that, if you've got a lot of debt, then yes, high interest rates are a problem. But if you're an income investor, looking for income, this is a great opportunity to lock in some of those things. I think the other big story for 2023 will be this economic recovery in China. I don't think that this is another super cycle in the same way as in the early 2000s, but certainly from a South African perspective, as a big exporter of mineral resources, there will be some tailwinds for a change. From a South African perspective. And then we know that the geopolitical tensions, we're actually starting to understand how this is starting to play out now. So it is a realignment. There's a new equilibrium. We understand now what it's almost like saying, okay, with the Cold War, we knew what we had, which was Russia one side, US the other side, or the West, and that side. We're starting to get a sense of where this is, starting to fall. So add this all up, the growth recovery, elevated rates, plus a sort of a new normal, equals the opportunity for us as fund managers to be able to take advantage of some of this. 2022, I will highlight again how bad it was in terms of as an investor. There was really very little place to hide. So either you just sat in cash earning 2%, or if you really were sort of lucky, you had some exposure to inflation linkers because of their high inflation rate story, and then you could sort of eke out a low single-digit return. So if you spread your assets across, fixed income, equities, and so forth, last year was a year to forget, basically. So I'll park it there. Let's then narrow in on basically the income side of things, or the income side of the equation. So when you look at inflation in the US as the major economy in the world, you can see I've highlighted on the right there, peaking at above 9% and now sort of having declined. I think the most recent number, in fact, is closer to 6%. But then go back to 1980 was the last time you saw inflation rates in the US at these sorts of levels. It was over 14%, sort of at the end of or at the beginning of 1980. And we all know what happened is that they pushed interest rates up. And I'm going to show this on the next slide. At the beginning of 1980, it's a little bit obscured there on the left. It reached 20%. So the Federal Reserve pushed interest rates to 20% to fight inflation of, let's call it 14.5%. In other words, if you think about the real rate was almost 5%. That crushed the economy, and we know what happens when an economy gets crushed: no pricing power, and inflation then dissipates out of the system. If you look at where we are today, with the not the repo rate, the Fed funds rate in the US, they've raised rates very dramatically from close to 0 to 5%. People have been surprised by the fact that there's no recession yet in the US. So where is it? When is it coming? Is there going to be a recession even? The economy looks very strong. And I think the point really sort of I want to leave you with, and I'm going to show you on another slide going forward, is that the key here is that the inflation rate in the US, as I'll show you here, is at 6%, and the Fed funds rate is at 5%. So they haven't even got to the same level of, let's call it a hawkish policy around the inflation story. And everybody's expecting, inflation is just going to dissipate. And it's not necessarily the case. Let's look at the South African, or let's look at the bond yield story, sorry. So this is the US 10-year bonds over the last, 2022, my year of crisis. And you can see these big moves from almost 1.5% at the beginning of 2022, peaking at above 4%. And then there's been quite volatile since October, as the market has absorbed, where we are in the inflation cycle, and, whether or not there's going to be, this rapid shift downwards in inflation. And there's been some uncertainty around that. And of course, the most recent move you can see to around about 3.5% on 10-year bond yields in the US. And that's not on the back of a better inflation story. That's on the back of a flight to safety with the Silicon Valley Bank failure and worries about what's been happening while the tide was in. And now that the tide is going out, which dominoes are going to fall. So there's this worry. And so now the flight to safety, so go and buy US treasuries. I think that's really the story that we're getting at the moment. So is it sustainable? Key question is, it's going to depend on where inflation gets to. Then let's look at essentially the South African government bonds side of things. So this is the one also from January. So if you sort of looked at the US 10-year bond, and you can see that we had this very clear sort of upshift in the beginning of the year and then essentially moved sideways. So now you look at South African 10-year bond yields, and we at 11.35% on the right there. And you can see there's been quite a bit of volatility, but generally speaking, let's call it from March last year through till today, bond yields in South Africa have remained above 10%. Now, for those of you that know what's going on in the South African context, is that there's quite an interesting phenomenon here, which sort of astute investors will pick up on quite quickly. And this relates to the South African inflation rate versus the US inflation rate. So blue South Africa, white USA, you can see over the last 20 odd years, most of the time, South Africa's inflation rate has been consistently above that of the US. And this explains a couple of things. Number one is why our bond yields generally are higher than those in the US. Number two, it also explains why, generally speaking, the rand will tend to depreciate against the dollar. So there is one little difference here, is that over that crisis period of 2022, if you look on the right-hand side, for a change, you can see that the inflation rate in the US was higher than in South Africa. Quite an interesting phenomenon. And yet, over this period of time, we've actually seen the rand weaken. And there's a couple of other issues that we leave for another day as to why that has happened. But ultimately, at the end of the day, what we're looking at here is that we thinking about this as South African income investors. And so at the end of the day, what you're trying to get to here is an income which is going to help you essentially conquer the South African inflation rate. So that's really where, as an income investor, what you're sort of trying to aim for. So I know it's Friday morning, but a little bit of maths to wake up your brain. Maybe it sort of hasn't, maybe that's a Monday morning sort of story, but this is for tired brains. I'll put out the maths for you here. So on the left-hand side, what we faced here is 10-year bond yield in South Africa, 11.35. South African inflation currently 6.9%. You're getting a real yield of let's round it up. Let's be generous, 4.5% real yield. If you're an income investor in the US, you can buy a 10-year bond yield in the US at 3.55%. Your inflation rate is 6, so you've got a negative real yield of, let's round it sort of down for them, of minus 2.5%. Which investor is better off here from an income perspective? Pretty much clearly that the South African investor, from a pure economic math sort of equation side of things, is in a better position to beat inflation. And then you have to start getting a little bit technical, and I won't do this today, but think about it, is that, you know, markets look forward. So then you should be saying, what is the expected inflation rate? So then you'd say, okay, well, South Africa's inflation, if you think about where we are at the moment, 6.9%, and it's expected to fall further. Why is this the case? Why has our inflation been so much more subdued than in the US? Well, it comes back to our growth equation. And I'm not going to go through the detail today because I don't have the time to do that. But essentially, because we have such a weak economic growth environment, and we know all the reasons for that, I'll check my lights are on, so no load shedding. That gives you the clue as to one of the reasons why we have such poor economic growth. And of course, when there's weak economic growth, very little pricing power, and hence, you know, the shock that we saw in the global context wasn't as bad in the South African side of things. So again, if you go back to this sort of equation here, you know, you can then say, okay, well, you can buy that bond yield of 11.35, and the expected inflation is maybe going to average, as it has for the last, you know, 15, 20 years, sort of 5 to 5.5, very, very attractive. So remember, though, is that, you know, this is an assumption that you're going to hold this bond forever. What we then do as a fund manager is we would look at the cycle and say, there are times when you want to buy, times when you want to sell. When we believe that there are risks that will push bond yields higher, and you may make some capital losses, whatever the case might be. Sometimes you can make capital gains, as we're expecting over the next 12 months, and then your return would not be 11% from the bond. It might be actually closer to 15%. So again, these are the sorts of things that we would then look at from a fund management perspective. So if I put it all together here, and in a summary, in this very quick nutshell, I think global inflation has peaked, but it's going to take some time before we get back to those old levels of like 2% in the US. Of course, if there is this global crisis that comes out of systemic risks that we're starting to see some of, I don't think it will get to that stage. I think it's different to 2008, but certainly the economy will slow, and then inflation will get back to those old levels quicker than what is currently expected. The recession risks will remain as long as rates are elevated. So there's people that are starting to talk about the Fed is going to have to come in, going to cut rates. Otherwise, you're going to get systemic crisis, et cetera, et cetera. those are things which we sort of have on the horizon, if I can put it like that. China's recovery, I think, will be key, as I mentioned earlier. Great for South Africa, good for the rand, good for commodity prices, etc. Locally, I know the SARB has been very, very conservative in terms of hiking rates, and they've been ahead of the curve, unlike the Fed. I think we're close to the peak in interest rates in South Africa. The questions now will be, when do rate cuts start? And I'm going to put my neck out there on the block, and I'm going to say, this time next year, we probably would have seen the first rate cut in the South African context. And then, I can highlight the fact that, remember that, the bonds that we're looking at here are South African government bonds. All of those systemic failures, and we don't need to go through the list here, and there are many of them, are embedded within those yields. And so I think those are not going to go away anytime soon. We've got a lot of issues around political issues, socio-political issues, socio-economic issues. You only have to look at what is planned for Monday by a certain party with the red caps. That's noise, but it affects sentiment and it affects what's going on in terms of the mood. And so in my mind, bond yields likely to remain elevated. And of course, that is an opportunity for income investors. In terms of performance-wise, I won't go through a lot of the detail. We have 4 solutions. The flexible income fund that you've highlighted, Eugene. Again, this is a through the cycle fund. And when we look at it from that perspective, what we're looking at, as inflation starts dipping, we need to start being prepared for when interest rates start declining. And there are opportunities there that we can start making use of. High yield fund is the one that won the Raging Bull Award a couple of weeks ago. Again, that's been a floating rate fund, great in high interest rate environments. And then, of course, you've got a money market fund and an optimal income fund. I won't go through the detail of that. But just to highlight then, if you go back over a number of years, the dark bars really, what we're trying to do in the flexible income fund ultimately is for investors who are looking for bond-like returns, but with lower volatility. That's our aim. And if you look at the returns, the dark bar against the gray bar, you can see the gray bar is the all bond index. Over all these periods, we've been able to accomplish that return objective consistently. And then just to highlight, what are we trying to do within this fund? It's bond-like returns with lower volatility. The blue side is our fund. The gray side is the all bond index. You can see the return on the left, the vertical axis. We've been able to outperform the all bond index. And then look at the volatility on the bottom, half the volatility. So I think that's mission accomplished as far as we're concerned. And so again, consistently through the investment cycle, that's really what we're trying to accomplish. How do we do this? I'll use 2 elements here. Is that the one thing we don't do in this fund is just to push the limits as far as risk is concerned. And then, as Warren Buffett says, when the tide goes out, you discover, so you were taking risks that were inappropriate for the time, and you didn't get prepared for when the tide went out. And just to highlight here is that over the last 2 odd years, having seen this higher inflation environment and expecting then higher interest rates, the one thing that happens with higher inflation rates or higher interest rates is that you then start to see defaults. And these are you have to be prepared for this. So in advance, my job as fund manager is to look at it and say, the landscape is telling me that there are heightened risks. And the one thing that you should then be doing is taking less credit risk into this environment. And I think you can clearly see here the proportion of the fund on the right versus the left is how we've basically increased the credit quality of the fund, not sacrificing the return. So we've been able to consistently through the cycle deliver return, but it's not by taking additional credit risk. The time will come when we can do that again, but now is not the time. Now is the time when you want to focus on credit quality, on high quality in periods of uncertainty. So I think that's the key thing. Number 2 is, and a lot of people ignore this, is liquidity risk, is saying, okay, you can see the environment's changing. Maybe South Africa is getting close to a peak of interest rates. How do we approach this? And what do we do? Well, if you're seeing that you're getting close to the peak, then you're going to have to change your strategy. But if you have no liquidity in your fund, then it's very difficult to change the strategy in the fund. So I think to highlight here is that if we look at the fund over the last 2-3 years, in anticipation of the fact that we are nearing the peak of a cycle, we've increased the liquidity of, and I don't mean here by just pushing, increasing cash. Essentially, it's looking at what do you hold? Do you have the ability, if required, to sell that asset and go into another asset that's appropriate for what you're going into? And you can see on the left here, December 2022, that's what, over 70% of the fund, almost 80% of the fund, we could actually shift within 0 to 1 plus 1 to 3 days. So I think that highlights our active management of what we're trying to do. and in anticipation of a peak in the interest rate cycle, such that the returns we're going to generate in this fund, we would hope, all else being equal, barring any sort of black swan type event that we can't forecast by its very definition, we essentially expecting very, very good returns, double-digit type returns of 12 to even maybe 15% if all things go well. And that's not an extremely bullish scenario. That's a limited bullish scenario where things just have to sort of almost bumble along in South Africa and we'll deliver good returns. So just to sort of end off then, I think the high bond yields, they're a boon for income-seeking investors. The South African financial system is very robust. So worries about what's going on in Europe and in the US in particular, where there are thousands of banks, compared to, I think in South Africa, we have a total of less than 20 banks. So it's not as fragmented as what you have. And banks are very well capitalized. And again, I said, see 2008. You had a financial system meltdown in 2008. What happened to South Africa in our financial system? Nothing. I'm not saying we shouldn't worry. It's just that we are in a different position to what's happening in the rest of the world. There's no need to increase credit risk in the South African market yet. I think at the moment, we're still seeing some of the dominoes fall, so we will wait to see how that plays out. I touched on the liquidity risk. I think it's important for us to be able to make a shift as quickly as possible. And then we're not saying that there's a bull market coming here in bond yields, unless you see this significant shift in global inflation outlook. So it's moderate gains, that's it. And then one last bit is that, the US dollar may be near a peak and the rand may well be in cheap territory. And that may well be also beneficial for us then. A stronger rand, of course, would help us on an inflation trajectory as well. And that's essentially my story. I'll hand over back to you, Eugene.
Extremely insightful indeed. And to our audience out there, the Sasfin funds forms an intricate part of a lot of the income portfolios or income solutions that we offer to you as investors. And being collective investment schemes or unit trust funds, these funds are 100% liquid, so you don't lock in for 3 or 5 year terms. And as Arno rightfully pointed out, the returns that you can expect are anything ranging between 3 to 6% above inflation, which I do find extremely attractive. Arno, thank you so much for the good work you and your team does. And to our audience, to you as investor out there, if you have any more information or would like to have any more information or questions, please make contact with your financial advisor and we'll try to address those questions as best as possible. Thank you to Paul for attending or listening to this recording, and we'll stay in touch and bring more of this kind of information through to you. Arno, to you and Martin, thank you so much. Be grateful for your time and we look forward to speaking to you again in the very near future. Thank you so much.
Great. Thanks very much.